Thank you, Judith, and thank you, David, as always, for an insightful and brilliant exploration of where we start on the road. I just want to say in opening the panel discussion today that if there is one person I associate with the phrase regulatory cooperation, international regulatory coordination, it is David Wright. So what a pleasure to have you here at the center of the panel. What we're going to do with this panel essentially is pick up on one of the key recommendations of David and Judith's report, that of hearing from the stakeholders. So to my right, if I may introduce my panelists now, we have Walt Lucan, Chief Executive of the Futures Industry Association, a key representative of the market. His members represent the listed and cleared derivatives market, and Walt is always a clear, considered and thoughtful voice in any debate on regulation. Next to him, Elizabeth Coley, now Vice Chair of Allianz Global after many years of being CEO. And again, a strong and clear voice in this debate. We have David, who we've heard from. To his left, we have Urs Rohner, Chairman of the Board at Credit Suisse, with whom we had an interesting discussion on systemic risk yesterday. And finally, to my immediate right, Michel Prada, now at the IFRS, formerly a chairman of IOSCO, and really someone who has seen capital market and capital market regulation evolve over the last decades. So what a pleasure to have you all here. To get us started, I'm going to ask one question, and I would like you all to respond quite succinctly. The question really is, where do you see the greatest risk of fragmentation? And Walt, though I'm looking at you, I'm going to go to Michel first.
Thank you very much. Let me first say that I'm very honored to be here. It's a big risk to invite an old veteran, so I'll try to catch up with present times. I have mixed views on this. On the one hand, we can see the risk of fragmentation due to the follow-up to the crisis, renationalization, the US statements that are made here and there, the consequences of Brexit. Let me read a sentence which comes from a Treasury report of October 2017. International regulatory standards should only be implemented through consideration of their alignment with domestic objectives and should be carefully and appropriately tailored to meet the needs of the US financial services industry and the American people. I've seen more encouraging statements to international diplomacy and cooperation. So we could see a big risk there enhanced by Brexit. But on the other hand, when you look at the reality and have been involved in this for 20 years, 20 years ago, the European regulators had one nice so-called working lunch a year. There was absolutely no dialogue cross-sector. Following Hans Dietmayer's report, we set up the Financial Stability Forum, and then we saw the development of the Joint Forum, and we saw the development of international organizations. And the US were instrumental in a way. You mentioned, David, the move to IFRS. Had not Arthur Levitt at that time worked with other regulators to foster the reform of the IASC, this would not have happened. And after all, the US have not recognized IFRS, but they have recognized IFRS for foreign listed companies in the US. And when you read the detailed reports that follow the one I quote, there are recommendations by the Treasury today which are quite encouraging. Encouraging to reduce extraterritoriality, to focus on domestic firms, be a little less hands-on foreign firms. So my thinking is that we need to continue. This is a long journey. This is a difficult one, but we make progress. I fully agree with David. We should not be pessimistic.
David is an optimist.
Well, I'm more coming from the receiving side of regulation, as you would imagine. Now, my starting point would be a global industry, a globalized industry like financial services, which I truly believe should be global, can only effectively operate if there are global standards that ultimately regulate it. And I think that's probably has been the common wisdom, at least after the financial crisis. Now, what we have seen now, the increase in fragmentation, even with the implementation of those rules, etc., and we can come to the details afterwards. Why is it dangerous? It adds complexity, it adds significant costs, and in the end, it also increases risk. I mean, if I would tell you what we have to do to be able to comply with all the rules and regulations that were adopted, and all have to, as a common basis, probably as a starting point, let's say Basel III or others, you would not believe it. Now, this is not just linear a little bit more. The complexity is multiplied, and in the end, it increases IT costs, but also IT risks. And in the end, there's a point where you have to ask yourself, have you really increased stability, or have you created another category of risk which can also endanger stability of the overall financial system? That's what I see as the ultimate risk. Now, I can have a lot of sympathy why individual countries may adopt different standards or try to adopt different standards or think, will we have certain specialities here, what we do. But the net result for a globalized bank is it adds cost and complexity and hence, in my opinion, also risk.
Thank you. We'll come back to some of those themes. David, would you like to add to your...
Well, I very much agree with what was said. I think that if every rule globally agreed is interpreted and implemented in different ways, there are not just huge costs, but actually complex risks. And I worry, frankly, today that we still don't know enough about the interconnectivity and contagion between markets, partially, I think, due to inadequate data that I spoke about earlier. So the two big risks right now, clearly, from my perspective, the US retreat from multilateralism, I think, is extremely serious development, and it's manifesting itself in different ways. You all know how. I think moving away, if they do move away from the WTO, will be immensely dangerous for the world economy. And of course, the second being Brexit. I'm not going to start on that because I won't stop. But let me say that that I think the lack of any clear position from London on not just financial services, but the whole package, but just talk financial services, is something that is extremely risky and dangerous. And there are serious financial stability risks involved here, not least of which covers things like data, hygiene issues like contractual continuity and so forth. So that's what I would point to right now.
Thank you. Elizabeth, speak to us not only from the perspective of Allianz, but speak to us representing the buy side.
Well, thank you very much. And it's quite interesting, isn't it? Because we've talked earlier today, there was a lovely phrase that I wrote down from the opening remarks of when we talk about resolution, we're not talking about fragmentation, we're talking about realities. And I think that is a very fair comment. Each jurisdiction has to know that when they are asked by their taxpayers and by their citizens, that they've done sufficient. So I think there is a very sensible undercurrent of reality. However, it's going to be difficult for this panel because I actually agree with what's been said by each individual on this panel, which is there is more good than is talked about happening in terms of global standard setting, a willingness and an attitude towards global cooperation. That's, I think, because there are many, many global practitioners. The market share of global companies providing financial services in the world is growing, not reducing. And therefore, whilst we have potential fragmentation, we also have market forces, both in terms of the way in which capital is being deployed and flowing, and commercial forces that are forcing greater globalization. And that's because it's very expensive to run the data required. It's very expensive to have the capital required, the liquidity requirements, and the regulatory and IT infrastructure that's needed to meet the standards expected by global standard setters. So we have to recognize that there are some forces that are driving not fragmentation, but globalization of certain capital flows and certain markets, and there's just no doubt about that. The challenge then is that then there will be global competition for where should that capital center establish itself, where should those activities establish themselves, and which of those companies are going to prosper. And that's where we need to make sure that we don't end up in a situation through regulation, fragmentation, really drifting into protectionism, that we don't end up with a situation where we are creating risks of regulatory arbitrage and regulation used as a competitive force. That is the area we need to be most vigilant about, because we need capital markets to be fair, effective, efficient, and resilient. They can never be risk-free. You know, the deployment of capital that is risk-free generates no return. There are many, many wise people with Nobel Prizes who can demonstrate that. The reality, though, is we need frameworks where we can rely on greater capital flows, because that drives jobs and it drives growth, and at the same time it drives returns for the buy-side clients, and it is their money that we're looking after.
This is an anthem for our time. Walt.
Yeah, I would pick up on some of the themes that David talked about. To me, you know, what's behind some of these movements, Brexit and the Trump election in the United States, is there seems to be a healthy skepticism about the benefits of multilateralism among the populations. You know, these were political events that caused both of these things to occur. And so I think we've not done a very good job of describing how open markets, trade, cross-border policies actually grow the pie for the normal citizens. And clearly there has been benefits to trade, but I'm not sure it's been evenly spread across the populace. So we have to do a better job, I think, of explaining why multilateralism benefits the general population. I think I agree with Michelle that this is going to be sort of the blocking and tackling. I think we can make progress at a lower level of politics. You know, I think we need to be progressing these issues on a day-to-day basis, trying to make sure that we are promoting multilateralism, cross-border policies. When we see them, we'll argue against those that harm cross-border policies, and when we see people opening markets, and interestingly, China, for example, as the United States and Europe consider whether to retreat on multilateralism, you see China opening up with President Xi's policies, one road policies about opening up the markets in China. So this is going to be a realignment in some ways of these major powers around the world, and we just have to be careful that we don't retreat too much. In talking about the Trump administration, I would say it's too simplistic to say we're retreating from multilateralism. I think there is a realignment in how, I think he talks about fair trade. I would underline the fair part. I mean, you can agree or not agree with him, but I think he is approaching a lot of these agreements, trying to renegotiate where the United States' stance may be in some of these things. I don't think he's anti-trade, but I think he's trying to reposition ourselves in the United States in a better position. Having said that, there's a risk to that. So, I mean, there's a risk that others may pull out, that others may fill that void. So that is not without peril that the United States does that. But I do think it's a bit too simplistic to say that we're retreating from multilateralism in the United States.
Thank you. Let me ask then this question in a slightly different way, which is addressing the question of trust that the Swiss Finance Council paper picked up, right? We've identified trust as a key component of improving the process of improving the world that we all live in collectively. So do you feel that fragmentation is a threat to the trust and sustainability of financial markets? And Walt, this goes to some of what you were saying about multilateralism. Take a stab at it first, please.
No, definitely. I mean, I was at the CFTC during the financial crisis, and because of the trust and relationships that I'd built with regulators around the world, it was easy for me to pick up the phone to talk about the issues impacting the markets at the time, at a time of chaos. And, you know, we do it the best we can to plan for those chaotic events, but at the time, you know, you can do as many rules as you want to, but in some ways those rules get thrown away, and it really gets down to personal relationships with your colleagues around the world. So I think it's extremely important that we build these relationships, that we do these events, that we build that those credits with our partners around the world, so that in the time of crisis, they give you the benefit of the doubt when you're asking for something, that you're asking for information. So I think it's incredibly important that trust be built up during times of calmness.
So how do we build trust? Elizabeth. Yes.
Well, maybe I completely agree with that. And the time to build relationships and trust is when you have the luxury of time to do it. And I think there are themes emerging, and there are global themes emerging, where Europe actually has an incredible role to play, to the point of recommendation about Europe looking outwards, not just inwards. And I would just quote two, which we might pick up on later. I mean, for example, we have a panel later on sustainability, on the way in which we can deploy money in a way which is sustainable, fair, efficient, and effective. There are no global standards yet. We have the FSB talking about what the company reporting requirements might be. Each country is seeking to really improve the way in which we're accountable for how money gets deployed. I've just led some work for the government in the UK on sustainable and responsible investing. There is a great opportunity to work on these themes where we can find mutual interest and mutual benefit for society as well as for capital markets. Infrastructure is another area. We know that the demands for capital flows into infrastructure and long-term patient capital investing are absolutely huge. There is no way in which the public sector can finance infrastructure requirements alone. Again, this is an area where within certain markets in Europe, you find remarkable thought leadership, but not yet something which is workable at a European level. So I would say we should look for the areas where there are real opportunities of genuine benefit, both economic and social benefit, this point about proving the social good. And we should work together cooperatively, and that's on a cross-public-private sector basis.
Thank you. I'll turn to David, but just to say on the subject of sustainability, which we'll follow up with in the afternoon, we actually at the WFE, we do have some global standards and we're working on more. So we'll look forward to following up on that one with you. David.
I very much agree with what Walt and said here. I think you can't underestimate the importance of personal relationships built up over long periods of time, people you can trust and talk especially when things get bad. That's fine. That takes you a long way. Doesn't quite take you far enough in my view, because in the end I think you need an underpinning of law as well. But I just can't resist one comment, Walt, about US multilateralism. I just sort of made a quick list. TPP, climate change, WTO, NAFTA being renegotiated. Certainly the impression to the rest of the world is that the US is changing its policy in a serious way. And there are other things, cutting funding to the United Nations organizations as well. And I mean, trust is also a partner who you can rely on, and post-war the US has been, and credibly, and we should all be grateful for that, the leader of multilateralism, spreading democracy, spreading wealth. But the impression around the world is that the United States doesn't want to play that role anymore. Right or wrong? My evidence suggests that there's some right in it.
Thank you, Ez.
Well, let me try another take on your initial question on trust and fragmentation. My theory would be the lack of trust probably also has resulted in the fragmentation that we see in the regulatory landscape. And let me give you one example, resolution, where I would agree we have done a lot of work, and I think we probably have come further along than most skeptics have assumed. But in the end, there's always this residual element that says, well, yes, we agree on principles, overriding principles that the FSB has adopted, that the IAF have suggested, and others. But we want to be sure that if the worst happens, we're still in control of our own destiny. And that has resulted in ring fencing activities that we have seen, particularly in that area. And when you think about it, why this is, it's probably, and this may sound almost ironic, there's still not enough time that has lapsed since the last crisis. People are still terrified about what they have seen in 2008. I am too. I can remember vividly that weekend at the Fed in September 14 and 15. And nobody wants to see such a situation again. And suddenly the day after you realize, oh, in the subsidiary you had in another jurisdiction, suddenly all the money was gone because it was transferred immediately before the bankruptcy occurred. Now, that's why regulators, national regulators, have started to make sure that there is a residual solution for what they call systemically relevant functions in their own jurisdiction, and they have to underpin that with capital, with liquidity, with rules, and that then creates the complexity. It's not something which you cannot understand. I can see where people are coming from, but I think in a way it may explain to a certain point why in the end total trust, if you had total trust that you have a regime of host regulatory rules, and it's clear that even if something really terrible happens, we would in a fair way then distribute what is left and make sure that nothing goes under, you would not have that. But I think that's unrealistic. It's just not the way the world works, and probably also not how politics work.
Well, again, I would like to take the optimistic view, but I have to recognize that the reality is different. Trust is based on dialogue and compromise. And what we have seen in some instances during the crisis is unilateral decisions. Think of Lehman unwinding, or see the management of CCPs. And this creates, obviously, a situation where trust isn't there anymore. And therefore, the countries or the regions want to have the capacity to control their own destiny. And of course, this triggers, again, some kind of renationalization or fragmentation. So we have to continue trying to build trust, but we have to be realistic. There are limits.
This brings us neatly to the next step, which is Brexit. And David said if we asked him about Brexit, he would talk all day. So we will ask about Brexit because we'd love to hear from you. But more to the point, Brexit is an illustration of many of the themes that all of you have highlighted in different, on different issues over the last 5 minutes. It's a political event. It's the will of the people. We must all abide by the majority, regardless of personal preference. We are now in uncharted territory, and we must walk the road, creating our own milestones. So my first question, really, on Brexit to all of you is, what do you, can we map the landscape a little bit? What do you guys see as the key risks, the key challenges, the key opportunities? And then maybe we could take a step back a little bit and address the issue of the impact it will have on global regulatory cooperation and how we navigate that. So Walt, you're nodding. Please go first.
I guess I'll start off here. Well, I think there's obviously significant risks to the marketplace on Brexit. I think businesses want certainty, and they want time to plan and transition. And we actually at FI just came out with a paper on the contingency planning for a no-deal Brexit situation. And we're asking for a 2-year transition. I think that is juxtaposed against how leverage works in negotiations, which is the highest point of leverage is right before deadlines occur. And you see this oftentimes in the United States in the Congress when the government's about to shut down, and that's when the highest point of negotiations occur. So those two things don't bode well for the industry, because the likelihood is there will be less transition time than we want, and it may be sort of the last minute deals that occur in order to maximize the benefits of the negotiating powers. This panel is much closer to the Brexit situation than I am, but I think to me that is the biggest concern, is that businesses just won't have the planning time in order to deal with some of these enormous issues. And they are enormous issues of where you're located. And so I think what will happen is you'll start to see businesses hedge their risk by implementing their contingency planning before the deal struck. They'll put offices and open some offices in different the EU 27 countries in order to hedge their risks of a no-deal Brexit. So to me, that's the biggest concern of fragmentation dealing for Brexit.
The uncertainty also is ongoing. And Elizabeth, Allianz in particular, you have a strong interface with the public, and there needs to be, a sense that there can be no perceptible change in doing business for those who trust you. How do you contend?
Well, I mean, our customers and clients should assume that we will be able to continue to support them and look after them. That's our job, and that's true for any financial institution. Clearly, there's a huge amount that the private sector can do in terms of contingency planning. The greater the uncertainty, the more the worst-case scenario has to be the contingency plan. That consumes resources, energy, capital, that could otherwise be deployed more productively, but that is just a fact of life. So I view this in three stages. There's pre-deal, there's a transition, there will be a transition just because of a physical impossibility, and even when we implement EU directives, we have a period of implementation, and then there's going to be post that. So I think what we have to look at is what can the private sector do to reassure its customers that they will be there. Then what can the private sector not do? And there are certain things, and it's particularly true for derivatives and insurance, where contract continuity cannot be secured at a sufficient level, and therefore we have to highlight, David called them hygiene factors, business continuity factors where it would be delinquent, frankly, for authorities and governments not to consider what the public role is. We need to be sure those are not padded. We need to be sure that they are genuine and get down to the absolute must-dos, not what we would like to do to avoid spending money where we don't need to. And a huge amount of work has been done, both by supervisory authorities, prudential authorities, and the industry to identify the things we absolutely must secure. Then you have a period of transition, and that will be what it will be. And the reality for the private sector is we will have to do in that period what we must do. It'll just mean that there is more diverted into what may be less productive from an economic growth and evolution point of view, and innovation point of view. So I think it's really about distinguishing between the essentials that must be done to avoid cliff edge scenarios that mean that we have market continuity, contract continuity, and client continuity. And then the rest falls on the shoulders of the private sector. But we shouldn't assume that the rest of the world is waiting for us to do this. The reality is that this is a globally competitive marketplace, and for companies who are not burdened excessively with Brexit or other internal issues to their region, they will storm ahead. And therefore, for global firms, it's also about how we deal proportionately with Brexit as well and make sure we remain competitive where we need to be. Thank you. David.
Well, I wouldn't describe this as a model negotiation at all. I'm quite incapable, and I'm sure it's true of everybody in this room, of saying how this is going to evolve. And I have a great deal of sympathy for business in this situation Elizabeth was describing. What do you do? Do you hold on and hope that some common sense might prevail? Or do you have to, in the end, resort to plan B and start moving people and functions, et cetera, et cetera? We are in a completely uncertain situation. Time is running out. The United Kingdom seems incapable of describing what it wants. In financial services, we have no idea. And the result of this will be a second best or third best outcome. I look at this in thinking in terms of what's the best outcome for Europe, for the European Union, and for the UK, taking account of the constraints and so forth. We're nowhere near this. We have so much uncertainty. And as Elizabeth rightly said, there are a number of issues here which have to be dealt with, that have to be dealt with. Otherwise, there is going to be a serious difficulties in the markets. And this requires regulatory activity, both by the European Union and the United Kingdom. So I don't think I felt more depressed for a long time. And I think that if we don't get some clarity for the UK, we're going to get down to a legalistic, mechanical outcome, which will be poor. Poor in terms of the economy of Europe and poor in terms of the access of the United Kingdom in the future. So I'd hope that both parties can sit down constructively, quickly, and start thinking about what is good for everybody here. That seems at the moment to be beyond the capacity of the United Kingdom. And in this process, by the way, we're talking about trust. Trust is evaporating.
What is good for everyone here?
Well, I think that's unfortunately not the question. The question was it's the least burdensome outcome, and frankly, from an industry perspective, I would say banks have to prepare for the worst. I think both Elizabeth and David have teed it up nicely. You have to prepare yourself now, and one element I would add is time is of the essence here. We cannot wait until March 19 and hope that it will be fine. If not, then we will start our contingency plan or activate it. That's not going to happen. That's not how this industry functions. So we will have to do that relatively quickly. And quite frankly, if the management is coming to me and say, look, that's the situation, that those are the options, but we think we have to start now, I will tell them, yes, I think so too. Because we cannot wait and hope that in the end there will be some sort of solution as long as you don't have absolute clarity about it. So you have to do all the work beforehand, and you will do it. Now you can say, well, this is just excess costs, and that's something, well, it's the cost of doing business in this global industry. That's correct. On the other hand, you also create facts. Once people have moved, they have moved, and it's unlikely that they will move back, only because a couple of months later you will figure out, oh, actually we can do it differently, and that would be even better or nicer. That's the problem that I see at the moment, and at the moment you have absolutely zero transparency about what the end game will be, and that's before we have even talked about the obvious things like to avoid cliff edge effects and other things. It's just the basic proposition: how do you structure your business going forward in case of a hard Brexit, in case of a transitional time that is acceptable, or in case of a transitional time that is not acceptable. And my guess would be that, within the next 2 to 3 months, the latest, banks will have to activate their contingency planning. Otherwise, they will not be ready by next year.
Thank you. Michel.
Well, I wish it were a nightmare, and we wake up in a year from now. The UK is still there. They are considering joining the euro, and the EU Commission has decided to adopt Greenwich time. But unfortunately, that is not the case. This is a nightmare, and we hardly see all the difficulties ahead of us. There is one which many people do not think about. It's the end of the legal integration in the EU. It's the end of Brussels I, Rome I, Rome II, which means that tomorrow decisions by British jurisdictions are not applicable in the rest of the EU. And in the financial sector, this is a nightmare, because it will require exequatur to enforce judgments, which means time, process, disputes, uncertainty. And of course, I'm not going to elaborate on all the consequences of the loss of the passport and all the strategies that you can design, relocation, externalization, and whatever, you name them. But this is a disaster. And it is not merely a sort of global diplomatic issue. It's the day-to-day functioning of our relationships. And to be frank, I was quite optimistic when talking about the future of international cooperation with regard to financial services globally. But on this one, at this stage, I'm quite pessimistic. Now, we never know. We know that Europe has gone from crisis to crisis, and at the very end of the time, you stop the clock and you find a solution. But here, the situation is totally different. This kind of crisis management was internal to EU members. And now we are in a situation where we are dealing with a country that doesn't want to be an EU member and that has internal contradictions. I don't see how you sort them out. So I think it will be a big difficulty ahead of us all.
Thank you. On that note, actually, I'm going to open midway for audience questions. I will take the panel back in our concluding questions. So if you want to ask a question, please do raise your hand. And I think there are mics or not. If not, we'll ask you to announce yourselves. Are there questions for the panel? Okay. No. Well, I'll come back to you in 10 minutes if you want to think about it. So let me ask you now a follow-up question on Brexit. We are in the nightmare, as Michelle puts it so evocatively. What is the model for international regulatory cooperation? What is the correct model? What is the model you all prefer, bearing in mind some of you will feel differently about this question? Walt, please go first.
I think the audience is so depressed after our panel that we've stunned them. It's Fat Tuesday. We should be happy, right? And
you all said you were optimists, apart from us, and now. Yes.
my wife's from Louisiana, so this is a holiday for our family to, on the day before Lent. But, anyways, no, I think, for us, the right model for international cooperation is, I think, the model we currently have. I mean, I think the good work that David and Michelle has done on promoting IOSCO and the FSB, and to me, the more dialogue, the more cooperation, the more we trust each other, the better. And there may be mechanisms, and I think David has been a proponent of improving the mechanisms of how we enforce some of the provisions at the international level. I think I've always been more of a skeptic, and David has known that of countries wanting to give up their power and the lack of accountability with that. But it's a strong idea. It's an important idea that would help to bring some of these global standards to bear, and to help with some of this multilateralism. So I think it's just more of the same, that we continue to sort of bear down with the groups we have, improve dialogue. I think it's healthy that the G20, the Pittsburgh Accord, came out with strong recommendations in 2009. We're almost through with implementing most of that. I think it's good that we are reassessing those provisions now, whether it's the EMIR review or in the United States, looking at the Trump administration, looking at the legislation that's been put in place to make sure it's pragmatic, that it's cost effective for business, that we can do it. And a lot of that has to deal with cross-border initiatives. So I think the mechanisms in place are important ones, and we should work to strengthen them.
Thank you, Elizabeth.
Well, I agree with that. And I think we're going through a very difficult and disruptive period, particularly in this region. I would say that what we mustn't do in that period is break what works, both internationally and in terms of regulatory cooperation. There's an enormous desire for consequence. We hear that word all the time. If the consequence is you cut your nose off to spite your face, and you look back in 2 to 3 years' time and think, well, that was not a very good idea, that has real global significance. So you talk about trust. I think one thing we should remember is that good regulation can underpin trust. And the EU has created some very good regulations. And I say this as a market practitioner, but it's true. I can remember back to 2003, David's services led a very, very important review of an old EU directive, the UCITS directive, that had worked well, but was getting old and was not sufficiently flexible and dynamic for a 21st century world. David and his team led that review, involving practitioners, modernized the directive. That has been an extraordinary global success. The UCITS directive is recognized through mutual agreement in 75 jurisdictions. We don't talk about that. And yet that was the spirit of the time, that if you have something that works, and Europe should be proud of the fact that that was created and kept alive. Now, if as a result of what we have to do in the next few years is somehow punish or have consequence for somebody leaving the EU, that's one thing. But if, at the same time, we undermine some very, very good regulation that's worked very effectively for European citizens and for European companies, and I say that as a global asset manager based in Europe, then that would be most unfortunate. So I agree with everything that Walt said, but I also would add to it, don't undo what has been achieved because of a short-term, politically, potentially fueled need for consequence.
So if it isn't broken, don't fix it, David.
Well, I very much like what Walton said here, and very much agree with Elizabeth as well. Just a few points. I mean, I think we've made, I don't want to give the impression that I don't think we've made a lot of progress. I think we have. And my argument is that the model we have today at the global level is not fit for purpose for the future. As markets grow around the world, we will see more and more fragmentation and more regulatory complexity, which is hugely costly. Now, we could, of course, all go the bilateral route. I mean, let me just give you a little insight of some work I did in London on asking the UK financial industry, what do you want out of a US financial services agreement? Bilateral, UK-US. And we talked to quite a lot of important people about this. Let me tell you what the answer was. Zero. Zero. Nobody believes in a UK-US retail market. Far too complicated, never worked, different rules, etc. Wholesale business works pretty well. Works pretty well, actually. Few hiccups here and there, bit of data stuff and people moving around. Basically, zero. What the big issue is Europe. So the bilateral stuff, we hear this from our good friends in the UK government. I'm afraid on the financial services side, don't buy it. You've heard my views about what's needed at the UK, at the global level. Here's 3 thoughts about what the United Kingdom could work with the European Union on. 1, building the most advanced data system for regulators and supervisors in the world based on real-time data, including a step change in supervisory cooperation. And by that I mean co-supervision of systemic institutions, and it would have to deal with what ELCA has to deal with, resolution of infrastructures and allocation of costs in the case of failure. I think that these sorts of ideas, working together to strengthen the global system, the UK has a big interest to do that outside the European Union. But my argument as well, the European Union also has an interest. So there's an area of cooperation, 3 areas of cooperation that were a senior UK politician to talk in those terms, I think could change the whole atmosphere about what we're trying to achieve. So I'm looking for the positive agenda here, and I think there's lots of ideas where we can move forward.
Thank you.
Well, if I could formulate some wishes, if I may, on how the global regulatory framework should look like, I think basically everything that was said is correct. I think enhanced cooperation certainly is something, but I would start even before. I mean, the question is, who should be sort of the body that adopts global regulations? Why is this important? Because I think ultimately no regulation really works fully unless there is also a tool to enforce regulation or to make sure if people don't behave, it can, it will have consequences. And that is something which is obviously very difficult in the current framework. I mean, after the crisis, we had the FSB, we had other bodies, but in the end, a lot of it was based on the common understanding and conviction that it was right what was done. Now that works for a certain period of time, But I think ultimately, if you want to do that, you need to have a possibility of enforcement, of regulation. That's number one. Number two is, if I could formulate another dream or wish, it would be that regulation is more based on fundamental principles, and they can be very tough principles, don't get me wrong, like you've had it on capital and others. What makes it so cumbersome is the desire to regulate everything down to the last bit, which then makes it extremely complex and then creates, in case this is not totally identical, all these additional complexities. I mean, that would, from my perspective, be the other thing. And the third point is what David mentioned. I think if you come to a system whereby on the fundamental global regulation, you have cooperation and clear cooperation among regulators, where the work is basically divided up, I think it would be helpful. It would make I would say the regulatory framework better. And in the end, I think it would also be an excellent tool to improve trust among all the market participants, including the regulators.
Thank you. Michel, will you be an optimist for us?
Well, yes. I think the global architecture is not bad. And I don't see the possibility to change it significantly, neither a need for it. What I have witnessed is the evolution of a very delicate balance between the role of governments and the politicians and the role of regulators. I have the feeling that at the beginning of the years 2000, regulators had more leeway. They were talking business, and in many cases, politics did not directly interfere. When we set up the IFRS foundation, there was hardly any political discussion on that. It was clearly an arrangement between securities regulators who thought that having a single set of global standards was good for business. The political difficulties came later. And I have the feeling that the crisis has created a new balance between the way the governments interfere with the evolution of regulation and the way regulators do it. So this is a very delicate one because it is a political one fundamentally. And you have to manage this issue of political legitimacy and technical relevance. We probably today have not found the right balance. This is one. And I would certainly support the view that we should give a little more leeway to the, in brackets, professionals. And in doing so, I would also believe that there is a need for market practitioners to be more involved, not lobbying for their own interests, but pushing in the direction of globalization and coordination and a fair, transparent system. It cannot be merely a discussion between regulators and politicians. The second thing I would like to say is that because I was a securities regulator, I have the feeling that our philosophy remains a little more too bank-centric. We have not addressed the issues of markets the same way we have addressed the issue of banks. And the way we look at markets is pretty much influenced by the philosophy of bank regulation. And this is probably something that should be also reconsidered. And finally, the issue of enforcement and dispute resolution is key. Now, it's a very difficult one, but regulators have been able to show a direction through MOUs. We should develop this, and maybe they could be able to build by themselves some kind of dispute resolution systems that would progressively create a solution to issues and foster mutual trust.
Thank you. Those are very constructive suggestions. I want to ask you, we've spoken a lot over the last hour about how markets are global and therefore regulation should be global. But I want to say to all of you that regulators, for the reasons we've discussed, are national. So how do we bridge the gap, recognizing that it is one that needs to be bridged? And Michelle, please go first.
Well, there are clearly two levels here. There is one level which I believe where we could make easily, in brackets, some progress. This is the EU. I do believe that we need to move to much more integrated regulatory system at the EU level, and I'm talking of the regulators, the so-called ESAs, the ESMA and the others. We need to reinforce them. We need to build a hub and spoke system. Whatever the national reluctances and whatever the difficulties, there is no case to build a capital markets union with 28 or 27 regulators. Doesn't make sense. So the direction here is extremely clear and fairly simple. At the international level, it's much more difficult, of course, and we must recognize that for a long time we will not have an integrated system, but good cooperation between regulators through well-organized, well-recognized, legitimized international organization is the second best, but it can work, and this is what we should foster.
Thank you. Ez.
I'll say the fact that the regulator is national does not necessarily mean he cannot regulate or apply global regulations for markets where it's appropriate. And that's exactly, I mean, that's what we have been discussing now. I think that's the whole point, that, you know, we have a regulatory framework which makes sure that those markets that are global markets can be dealt with in the same or similar way across the board. And my impression is that's not a problem basically for the national regulator per se. It becomes a problem when there are individual objectives that you want to achieve, be it to protect a certain part of your home market or for other reasons. Then you start to basically disrupt that system. But per se, I mean, you have to live with the idea that you know, you have people in a country that are responsible to supervise certain markets. What the rules they apply is ultimately a political decision by that respective country.
Well, let me talk at the global level, and I agree with what Michel has said here. I think there's a number of very simple Jean Monnet practical steps we could take now to improve things, such as agreeing that before we implement a globally agreed rule, we sit down with the technical experts and decide on the definitions, on the scope, all the technical issues that can end up with different laws being applied in different jurisdictions. That would help. That would save a lot of downstream repair. We can also try to agree that we will implement the rules at more or less the same time. Otherwise, you get the first mover advantage situation. One jurisdiction, especially if it's a big jurisdiction, goes first and says, well, here's my law, you know, the rest of you just follow this. Well, that doesn't work because another jurisdiction might say, hold on, you've got the definition wrong here or the timing wrong there. So there's two simple things. Try to do the job together and try to coordinate upstream. There's no reason why we can't try to improve the governance and transparency and links with the private sector. Michel was talking about Urs as well. Those are practical things that will help. There's no reason why we can't start right now to try to build a real-time data system and build the cooperation agreements around that. There's no reason why we can't start an informal dispute settlement system, again, what Michel alluded to. Now, that wouldn't be binding on the parties, but it would be pretty difficult for a country who had manifestly not applied the rule in a correct way, condemned by everybody else and saying, I'm sorry, you're just wrong. You could even publicize the outcomes of that, by the way. I mean, there's 5 points that we could start on tomorrow. And I would add a sixth, which is the coalition of the willing, the ones who want to strengthen the global institution, should start work, the legal experts, to start thinking about a treaty, a global treaty, with binding provisions on enforcement. So there's a lot we could do right now. Political will is what's needed.
Well, I'd love to believe that was true, and I think it would be marvelous as a global organization to have that global agreement. My biggest concern is we end up with 3 levels of duplicative regulation, that we have national competent authorities who, for democratic and state reasons, have to maintain their national competent authority. They are the competent authority. We then have, say, a regional overlay, and then we have a global overlay. And if as global practitioners we end up with that, and it's not harmonized and it is different, it's a disaster. So I think there's much more work to be done on talking about the difference between truly global markets and retail markets. And as somebody very wise said at a dinner last night, the transition mechanism between the macro and the micro. We need to do some very careful, thoughtful work about this, rather than talk about institutions in a way that is not differentiated. So, for example, there is no way in which I believe that individual domestic retail consumer protection will ever be done globally. That's obvious. We could argue that there is one major global market where it should all be global. Let's take FX. We've had a few crises in FX, we've had a few scandals. A huge amount of work went into creating a consistent, by central banks, a consistent code for FX. I watched that work because I was doing work in the UK on wholesale markets post the LIBOR issues. It was a valuable piece of work, but it ended up at a principle level as a forward to individual central bank codes on FX. It's great, it's good, but the distance between that and local FX market supervision is massive. So I think we have to be very clear on the structure and hierarchy of what we talk about when we talk about global, ESA, or NCA regulation, and be very clear that there are certain things that are not duplicated in that development. We also need to have a test, I think, from a practitioner point of view and a customer point of view, that it is adding value and that it is not merely duplicating for sense of cohesion. So, for example, what I would do is say, within Europe, I would say there were certain things where there should be absolute minimum standards. Where there is a national competent authority that's doing that, there should be minimum standards. And if those minimum standards are not met, the ESA should have the ability to point that out and say, we are not meeting these minimum standards, both for the adoption, the supervision, and the enforcement against directives and regulation. We've never actually done that. So we leaped saying, let's create an ESA, and whilst I agree in some of the principles that we need to strengthen ESMA, for example, it should be very clear around what we are strengthening, and we need to be very clear about where those competencies lie. And that requires, I think, significantly more work that's been done. At the global level, I actually agree with Urs that it's very difficult to go beyond principles, but we should absolutely have a coalition of the willing around principles. I agree with that.
Thank you. Walt, is there agreement or disagreement?
Yes.
With all or part? Can you give us more detail?
I think I agree with Elizabeth that there's a strong role for global standard setters, but there's just, and I think David, when he finalized about trying to create a global regulatory authority, said if there's political will, and I guess that's my question, is whether there's political will. So I think in the meantime, in the more practical time, global standard setters have a role to play, and we've seen that in the PFMIs, how they've strengthened CCP recovery and resolution, and the different things of strengthening the regulation of CCPs around the world. We've seen IOSCO with its MMOU on enforcement, and Michel was sort of the father of that, which through a name and shame arrangement, we were able to get a lot of countries into compliance with international standards. So to me, there's a strong role to be played by global standard setters. To me, the biggest thing is trying to get national competent authorities to think globally. Sort of the thought of, think globally, act locally. We have to, as national competent authorities, be willing to understand that cross-border business is important. And so, at the CFTC when I was there was always a strong, in our DNA about making sure that cross-border business worked. And whether you call it equivalence, deference, mutual recognition, substitute compliance, whatever the term of art is today, those concepts are important to make sure that there is a regulatory system in place that works. If we start to fragment, if we start to move locations of institutions because we want to regulate them, the costs of doing business are going to go up significantly. And that's not just a cost on business, it's a public policy cost. So I was in New York during the Lehman Brothers crisis, making sure Lehman Brothers futures business was ported to an FCM that was healthy enough to accept those positions. MF Global, I was also at a clearinghouse at that time, more difficult to get those futures portfolios transferred. I worry today that if a Lehman Brothers occurred today because of Basel capital requirements, because of the cost of regulatory institutions, there may not be willing acceptors of those portfolios anymore, just because they have to be the willing, as we talked about. And so we need to create an environment that regulatory institutions want to take on that business for the benefit of the marketplace. So right now, I'm worried that the more we fragment, the more costs go up. That actually has a public policy concern, not just a poor business concern, but really it's going to impact the marketplace.
Thank you. I don't want to end on worry, actually. So Dr. Weber, you have a question for us. Please.
We don't have mics, so I'll speak up. I guess I could be understood. We had a lot of discussion about where we're heading. Thank you. This involved... Sir. We had a lot of discussion about where we're heading for cooperation, and it involved, of course, given the panel, a discussion between Europe to some degree, very internal discussion, and US. In our today business, Asia is a much bigger part of where we see growth, where ease of doing business is increasing, where China is emerging already as the second largest capital market in the world, a much better chance than the EU to develop to overtake the US at some point, given the dynamics. So is there a role for reaching out, and I think David put his finger on it, when Europe defines and goes ahead with global standard, is there a chance that these standards get adopted in Asia, and that Asia, actually a first best practice would be to input into global standards and not just look at US-European relationship, but more globally towards Asia? I'd like the panel not to finish without having mentioning sort of Asia, at least at some point. Thank you.
Well, I think Axel is making a very important point. But what strikes me is that many of the sort of technical or intellectual disputes that take place here in Europe, or possibly in the US, do not in Asia. And we see, in my domain anyway, a tendency in Asia to endorse the standards very quickly. We are struggling here in the EU with the so-called IFRS 17 for insurance. Well, it is being implemented. I was in Hong Kong a couple of weeks ago. So my feeling is that Asia, Oceania is moving forward very quickly. And at the level of the standards, they adopt them. I don't know how they implement them, but the fact is that Chinese accounting standards are nearly word-for-word IFRS. And in the rest of the region, IFRS is spreading very rapidly. We don't have the kind of disputes we've here about, I don't know, fair value or whatever. So my guess is that they are moving fast. You're absolutely right, of course, that we should be more aware of that in our discussions, less transatlantic-centric. But my feeling is that they are moving forward very speedily with these standards as they are.
Do you have a comment? Or?
I think if I had one comment on that, yes, I think I see it as a chance also that, with an added, I'd say, big player in the market that will be getting bigger and bigger. I think the necessity to agree on global principles, at least, as I would call it, is even more pertinent, and probably the likelihood of success is also bigger. But it also means you have to, I think, in the end, you will have to focus on tough principles rather than elaborate systems.
Thank you. Elizabeth, do you want to come in? Or?
Well, yes, I'd just say that I completely support what Michel said in terms of rapid adoption. I don't think it's adoption and then it's status quo, though. I think there's going to be an evolution of those regulations, and there's going to be local practices which will shape them. And therefore, I would fully support that post-adoption, that dialogue needs to be very close, and we need to keep it going, because I think we could well find innovations, challenges, and subsequent thinking, and that's where we need to be externally focused, rather than worrying about dotting I's and crossing T's internally, on points that frankly have been accepted, and the next wave of 21st century thinking happens elsewhere. So I would fully support that.
I would just quickly mention that some of the international global standard setting in China, for example, has been very effective, like the PFMIs. The Shanghai Clearinghouse now is in compliance with the PFMI standards. So, us being able to go to them and say, you're not up to standards, you got to get yourself up to standard on some of these regulatory requirements has been extraordinarily important. I think there was a saying that in the Chinese, you cross the river by feeling for stones. That China moves very slowly, but I got a sense, and some of us were in China recently, that the pace is picking up. They just announced last week that they're going to open up their iron ore futures contract to foreign investors. Crude oil is launching in March. They've allowed foreign ownership in different broker-dealers and FCMs to increase to a majority ownership. So China's going to be a big player, I think, coming forward, and I think Axel's right that we have to pay strong attention looking east as much as looking west.
David?
Well, no, I agree, and I think that it's absolutely desirable that the emerging market countries adopt the best global standards. They are, of course, in many of them, the biggest ones in the G20 and FSB, and so, in a sense, are bound by the outcome. Michel is right. I think they do implement quickly. Whether they implement in the same way as the United States or Europe is another matter. But what they haven't progressed on is an internal Asian or ASEAN market. If you ask how's it going on the free movement of investment funds, there's a lot of talk, but the ASEAN countries are not prepared to build institutions to deal with disputes. So I think they have a long way to go internally, provincially, if you like, but I think we are seeing, and I think Walter's right, I was at the same meeting as he was, there's an acceleration now. And again, I think we all have an interest to try and converge, implement, and enforce the same standards, which for us means that he can do more business and not waste, or Elizabeth, an enormous amount of resources working out the rules in dozens of different jurisdictions. I mean, what sort of sense is that? Thank you.
Thank you. I'm going to end here, but just to reflect briefly on your question, Dr. Weber. I mean, 40% of our membership is from Asia, and we find that they are all present around the table when we set standards or make decisions, and they are a quiet voice. So where they are soft to vocalize, they are fast to execute. And that, I think, perhaps is resonant with what you were suggesting.